how should entrepreneurs and founders think about managing and also anticipating risks and different scenarios around that as we start thinking about 2025 and beyond?
I think if you're a founder, you want to be thinking of asymmetric bets, right? And really, what are those bets that will really leverage the outcomes of your company, right? Especially on a venture-backed company, right? Maybe I'm extrapolating here a little bit for other types of companies, but hey, if you're in tech and you're venture-backed, you probably want to be on the high-risk assumption to deliver higher outcomes, right? Look, it's thinking in bets and trying to understand what is a useful framework for us. And there are many out there, but we've developed one that allows us to be thinking of launching bets to market that maximizes our outcomes in 2025 when we think of our subsequent milestones as a company, right? And this is basically how we're doing that, conducting a roadmap that from a product perspective, so that from the product evolution, maybe you want to be thinking of tackling new personas. Like we sell to finance teams, right? Like we are also selling to revenue operations teams or RevOps teams, or HR teams, right? Thinking new personas, what do they need? Maybe, on the go-to-market side, who do we want to be? How do we shape our brand, or how do we conduct some of our outreach motions so that we maximize our outcomes? You can conduct a roadmap of bets that allow you to maximize your outputs there. I think in general, as an entrepreneurs, we have maybe optimized in the past too much for valuation. And I think this is maybe a lesson that probably we all learn through cycles. It's not only in the last one, but the previous ones as well. And I think, hey, we have an opportunity today to be thinking also of dilution, to be thinking also of, raising at levels that allow us to hit targets and, raising the amount of money that you actually need to deliver on your next milestone and be very healthy and not maximize. If you think of it like if you're a rational economic animal, right? So you want to maximize valuation all the time, but maybe if you are even more rational, maybe you don't want to do that. And, be humble enough and think, okay, hey, how much do I need? How do I optimize a little bit for dilution there? But, do something sensible that allows me to grow into that easily. We see many companies today in the private markets, of course, trapped into still a very old valuation, right? And then trying to, win time against that. I think today, businesses that have realistic expectations about, equity pricing and have strong business fundamentals, and the companies that have managed to move their value proposition into mission criticality. So those that are mission critical for their customers, and this is a big topic for us, those that are mission critical for their customers and are thinking of, not incremental, not optimization, but really bold bets and moving very fast and learning very fast from those bets. Yeah, we see a lot of success, and definitely that's our philosophy getting into 2025.
You may want to comment that I like that what I want to pick on a little bit more, which is you said win time, right? Like between expectations on valuation before versus now. What does that mean, like fundamentally in practice, especially for first-time entrepreneurs that haven't gone through a business cycle before?
Basically, that means that you raise a valuation that was overpriced, and then in a market downturn or in a market reverse to mean, that valuation gets adjusted. And then when you need to hit revenue targets that are not reachable really to adapt into the new multiples that allow you to do a flat round or hopefully an up round. Basically, you raise at some multiples that were disproportionate, and then you don't have the time in 18, 24 months to grow into the revenue targets when you adjust for, maybe you raise at 40 times revenue and now it's 15 times revenue. Well, good luck with, filling the gap with pure ARR growth. We see a lot of people, of course, extending runway, bridge rounds, venture debt. There are different ways of trying to bridge that gap and win that time to hit the revenue targets that you need to raise at a flat round. I think again, so don't think from that. We need to come to senses and then be very realistic like a Dan Brown is not bad, right? So you got a free ride, maybe you're paying it back, it's fine, right? And then you normalize that over time, and it's okay. So maturity also as an entrepreneur, like okay, might be fine. Of course, be smart about it. Still, focus on your customer, focus on the fundamentals, focus on those asymmetric bets, and it should be fine.
John, what are your thoughts for entrepreneurs and tech employees?
It made me think of some more macro context that hopefully is helpful. I was checking out the data last night in preparation for this. Forward PE multiples at the bottom of the financial crisis, so March 2009, 15-ish years ago, there were 10. Now they're 21. That's not going to happen again. We're not going to get multiple expansion to that degree over the next 15 years. Stock market in the US over that period delivered 15% annualized returns. It's one of the best 15-year periods in history. Speaking to Julio's, comments about expectations, like if you've come of age professionally in this time period, your expectations might be anchored to what is an anomalous period for increasing multiples, very high returns. And like I said at the beginning, it hasn't been evenly distributed. Like at some points in the cycle, some sectors or business models are hot and other ones are hot and other points in the cycle. I don't know how to predict what's next on that. I guess my point here is it's not rational to expect the type of multiple expansion that we've seen in the past to go forward. So what you actually need to work on is not multiple expansion, but doing good by your customers and building a good product that people want to use that you can produce for less than you can charge. Like very simple, like basic stuff, because the multiple, you're not going to be able to control what it is. It's going to bounce around. Also, your expectation should be set that like we're probably not, I can't say definitively, but we're probably not going to get 15% annualized public market returns for the next 15 years too. Maybe there's some mean reversion. I don't know, but I guess other context. Well, I think this is interesting, but margins. So you look at margins on these companies, just for the market as a whole, they're at the highest they've been for at least 30 years, probably in history, except for like a brief moment post-pandemic when they like shot to the moon and then crashed a little bit. But like essentially margins have been increasing for decades. On top of that, growth is higher than historical growth. So like the reason that multiples are so high is because of that fact, most likely. But is it reasonable to expect us to continue to accelerate growth and continue to increase margins? Like, I think that's a tall order. So I think just setting expectations, like don't get too anchored on valuations from 2021, because I can't say definitively, but it's unlikely to come back. Like be a bit more realistic, raise capital with expectations that you realistically can meet, and you'll be better off for it. Because what does it matter if your company is worth $1 billion, but it's just on paper? Like that doesn't do you any good. You have to actually turn it into liquid wealth at some point.
If I'm hearing you correctly, you're saying at the bottom of the last cycle, which was somewhere between like late 2018, early 2019. Oh, sorry, 2008 rather, and early 2009, right? And during the trough of the global financial crisis, right? Valuations on earnings, so valuations on profit, more or less, right, for businesses were half of what they were, right, at the peak, right, 10x versus 20x, if I heard you correctly. But during that time period, like companies more or less were growing more than 15% per year in order to, if you can sort of extrapolate from a sort of macro public market point of view, public companies in overall were compounding 15% per year, which means sort of more or less, given those companies underlying the macro point of view, they were at least hopefully growing 50% or more.
They were growing a little bit less because the return was 15% annualized.
Right, of course. These are the compounding.
But a big component of that return was multiple expansion,
right?
Because of faster growth and expanding margins. But those profit growth has been less than 15% per year. That's how you get like a much higher multiple, is through that multiple expansion. But your point stands. Yeah, exactly. It's my point is that you probably can't expect that again. Like, it happened, but it's probably not going to repeat. We're already at pretty extended valuations again in aggregate. Now it can vary by industry and sector, but yeah, that's the point. I think the main thing I'm trying to say here is focus on delivering the product and the value to your customers, like Julio was saying, and valuations, they'll take care of themselves, but I have to care about it because you're the one that's going to be deciding, do I take this round at this valuation or that valuation? And just have some realistic expectations there.
Yeah, absolutely. And I think the other point that you made was quite interesting is, we've gone through 30 years, right? A 30-year cycle, which also coincides with the fact that the world has been in a very globalized economy, where there's tons of trade, there's lots of debt, there's printing of money. I think it's not, it's fair to say that things are reversing today. We're deglobalizing. Cost of production, cost of capital still remains high. So along with that also means, to your point earlier, like focusing on really delivering that ultimate value to your customers with a smaller, doing more with less, right? Which is what we've heard, like with a smaller pie. How can we do that in a world that is systemically going to be different for the next 30 years?
Also, high valuations, if I may very quickly, lead to all sorts of complications, right? When you think of potential exits. And we see many companies, misaligned with investors in their own cap tables because, they felt trapped. And to John's point, which was, I loved it, like you might have a 1 billion, you are a unicorn on paper, your real value is way less than that. And you cannot truly exit because like the board is not going to approve that. So they place you in this very tough position to, go and assume more and more and more unrealistic risks and potentially even crash or fold the company. So those are very difficult situations some entrepreneurs find themselves in.